Well, good afternoon, everyone. We want to thank everyone for joining the National Black MBA Metro New York chapter for today's real estate session. We have Vonetta Hawkins, and we also have Larissa Longcamp, who is going to lead today's discussion. We ask you to please put yourself on mute until you're ready for a question. Feel free to ask questions via the chat, and we will have ample time to answer a number of the questions that we have today. This is one of many sessions that National Black MBA is going to have in regards to literacy for real estate and how we can improve opportunities for African Americans not only to understand the landscape of real estate, but more importantly, how do we inspire, how do we impact, how do we ultimately leverage real estate as a form of wealth. Today's topic is going to discuss some of the myths, top myths, of real estate in terms of the home buying experience.
So, like Norvell was saying, we're excited to continue on this journey around ownership and really speaking to everyone as it relates to real estate and just leveraging all the tools that we have out there to make it really available for the masses. And one thing he mentioned is wealth. And I would love to just start a story before we jump into our session, just around the importance and how homeownership really means wealth. Because sometimes I think that people don't necessarily tie the two together. So I'll tell you a story of two people, myself and a friend of mine. I come from a background where I am the first homeowner in my family. My mom, my parents, grandparents, siblings have never owned a home. And with that being said, it's fine, it's great. Once I got a house, everybody had a house. But with that being said, from a wealth perspective, I don't have, my mom doesn't own a house at this point. My friend, on the other hand, I mentioned to him one time that, his family is leaving him wealth and he has wealth that's built. And he was like, I don't understand. What are you talking about? And what I explained to him was that his parents, they own a house. They own it free and clear, which meaning they have no mortgage on it because they've owned the home for over 30 years. And I said, if your parents were to die today, you right now will have $250,000. I said, if my mom passes away, the great thing is she doesn't have debt, so I'm not going to I'm not going to have a debt and bills to pay, but I'm not going to have $250,000 either. So a huge difference of someone being able to inherit wealth, you be able to provide that to your family. I think it really helped open up his eyes that he does have wealth and that homeownership builds wealth. So, I would hope you would take that story. And sometimes I want people to understand it's not just let's talk about homeownership and how we can call things home. Owning a property opens up so many doors. Whether you're a small business owner, you can use that equity in your property as leverage. A home, the value that you can get out of that is enormous. And it definitely builds wealth. And, with this organization, that's what they're looking to do for their members. So I'll stop there and then I'll just with my stories. And then I would just maybe, so we have new people to this call, I would just allow Larissa some time so she can introduce herself.
Great. Thank you, Vonetta. And good afternoon, everybody. So my name is Larissa Longchamp, and I've been in the mortgage industry for about 15 years. And I'm happy to be here. And I want to echo what you just said about homeownership as a way of building wealth for many people, for many families. The key is that it can be, just as you said, it's a step towards building generational wealth. So I recently, it's interesting, I heard someone say the other day, when you purchase a home and you start to build equity and you're building wealth probably for your children, but you're also really building it for your grandchildren. Because, as you advance in life and you build that asset and you build equity in the home, and eventually what happens is your children may be at a point where they're starting themselves out. But as that wealth continues to grow, it's a starting point, hopefully for them and for their children. So many people use the equity in their homes to finance their children's education. They use the equity in their homes to start a business, to finance their dream of entrepreneurship. There are a lot of different ways that people use that equity that they've built up over time. I had actually thinking about something similar to what you just described. I was talking to my cousin the other day, and they're in a home here in New York, in Long Island, and it's a sort of multi-generational home. So my grandmother bought the house, and she had the foresight to say, you know, I want to make sure that I start to build something for my children. She has 7 children. And at the time, 3 of the children moved into the house with them. So there's, you know, one cousin upstairs, another cousin downstairs, and then another one in the basement. So one cousin, and they put some money together to buy the home. And this was about 25 years ago. So one cousin decided she wanted to leave New York and start over in Florida. So she took her piece of the equity, and with that, she was able to buy a home in Florida. Another one is still there, and the other one is still there downstairs. But we were talking about her mortgage the other day, and she's down to about 7 or 8 years left in the mortgage. So a couple of things have happened. They've almost paid the house off completely. And the second thing is, in that time, the house has gained in value. So what that means is there's money there for her children, and for the other cousin's children. So that's the power and the value of building generational wealth through home ownership.
Awesome. Thank you for that, Larissa. Thank you. Appreciate that. So I'm just going to jump into, we had, when Norvell did the introduction, he spoke about 2 myths, or the myths around home ownership. So today's session, we're just going to really dig deep into the 2 biggest myths around home ownership. So Larissa, let's have you talk. What are the 2 biggest myths? I wish we can do, like, I want to ask a question rather than give the answer for the 2 biggest myths. So
right.
On your phones right now, or on your computers. So Larissa, tell me the 2 myths, and then I'm going to do a little poll with the people online.
Yep. Well, let's start with the first one, and then maybe we could start with the poll.
Okay.
So the first myth, and probably one of the biggest myths that continues to persist, is about the down payment. So how much of down payment is required for someone to purchase a home?
Yes. So for everyone on the call, if you could just maybe type in the chat how much you think is required for a down payment to purchase a home. Norvell, you have to do the chats because I can't see anything. Okay. Oh, something popped up.
So we have 10 to 20%. We have 10%. Let's see here.
Don't be shy. Don't be shy. I'm gonna tell you, they're not right. So
there's always extra credit.
All right. Well, we'll take that. We'll take. So
we have a person who mentioned varies. It does vary. So roughly 10 to 20% varies. Depends. Someone said depends on the type of loan that you offer.
Gotcha.
Pretty good. Okay.
True.
So did we have a few 20% responses?
10 to 20.
Okay.
10 to 20.
Right.
Someone said it's best to have 20%.
I'm not upset. Best to have as much as you can. You can. All right. So, Larissa, let everyone know, what is the number 1 myth around down payment?
Yep. So that number 1 myth is that a lot of people still believe, and so far this group has done pretty well because we've gotten some different answers, but a lot of people believe that you need 20% to buy a home, and you actually do not. So the statistic is around, I'd say 39%, I think, when I last saw, of current, I guess, renters believe that they need 20% to put down on a home. And that's not the case. You can buy a home depending on the property type, as some people alluded to, depending on the property type and the type of loan product. You can buy a home with as little as 3, 3.5, or 5% down. And so when we're talking as I often say, we're living in a high cost market. So when we talk about New York and the New York metropolitan area, and we talk about home prices, when you're talking about, well, let me put it this way, 20% of a lot is a lot, right? So when you're talking about home prices upwards of, you know, $400,000 and $500,000, talking about 20% being on a $500,000 home, you're talking about $100,000, or even on a $400,000 home, let's say, you're talking about $80,000. That's a lot of money compared to a 3% or a 5% down payment. So on a $500,000 purchase price, you're talking about $25,000, or on a $400,000 purchase price, you're talking about maybe $20,000.
And then I would also just add is that there are programs out there that where you can get 100% financing. So some programs, whether they're veterans, USDA, which is properties purchased in rural areas, and even just some lenders alone actually offer 100% financing on some of their deals. So just being educated around what's actually available, what does your maybe particular bank offer, but doing some research, you'll be happy to find that there are various different options when it comes to down payment. But the great thing is the myth is debunked that you do not need 20% down when you are purchasing a house. And actually, from a statistical perspective, Freddie Mac, which is a major entity where most loans kind of go through, or one of the entities in which most loans go through, their statistics show that on average, the average home buyer puts down an actual only 13%. So across our entire country, the average down payment is 13%. However, the average down payment for that first-time home buyer is actually 7%. So for those first-time home buyers that are out there, putting nowhere near 20%. That $80,000 that Larissa said is a huge amount of money, but they're definitely, from an average perspective, the average for first-time home buyer is only 7% that they're actually putting down. So Larissa, when we think about those down payment and whether it's 7% or 13%, there are different products in which consumers can utilize from a down payment that will help with maybe a lower down payment option. So the traditional, let's say, two options that are out there are FHA, which requires 1% down, and then our traditional conventional products that might require a different percentage down. So can you talk to us a little bit about maybe the 3% conventional product that would be beneficial for consumers?
Right. Yes, I'll do that. And actually, before I get to the product, there's one other thing that I want to mention, which is a little bit why you're able to less than 20%, why in a lot of cases it may even make more sense. So I'll start by just talking about what it is for those on the phone who may not be familiar. You may often hear the term PMI or MI for private mortgage insurance or mortgage insurance. And what the mortgage insurance is, it's an insurance that the lender will take to protect against the possibility that you as the buyer default on the loan. But what that also does is allows that lender to lend you the money without having a 20% down payment. So 20% had been considered sort of the safe number that reduced the risk for a lender. So now a lender can get private mortgage insurance, and that's an additional amount that you pay monthly when you're doing less than 20%, but it allows the lender to finance more than that 80%. So a lot of the programs that we talk about carry the monthly mortgage insurance, but I also think a lot of times PMI gets a bad name. So I've heard people say, oh, am I going to have to pay PMI? Oh, no, not the PMI. But when you look at it, you could be talking about paying just a few, well, depending on the amount that you're borrowing, depending on the type of property and your credit score, the PMI might be, it could vary, but let's say a few $100s. So maybe in some cases it might be less than 100, but it might be 100 or maybe even $200 a month. But again, when you talk about putting down 10% versus a 20%, right? So you might be talking about not having to come up with an additional $40,000 or $50,000. You're paying $100 or maybe $200 a month. Again, that all depends on your loan. to get that loan without having to come up with that extra several $1,000s for the down payment. So paying the PMI may be worthwhile for some people. And PMI eventually can be removed. Again, depends on the loan program. So that's the PMI, and that's what enables a lot of lenders to offer products that allow you to borrow more than the 80% or to put down less than that 20%. So there are a few different programs. There's FHA, which you might hear of a lot. FHA is insured by the government. The minimum down payment on FHA is 3.5%. FHA carries monthly mortgage insurance, and you may also have to pay some upfront. But FHA also gives you flexibility in terms of things like credit score and that down payment requirement because it's a government insured loan. There's also the conventional products. So the conventional products are backed by, you might hear about Fannie Mae, Freddie Mac. So those are two government sponsored enterprises that provide backing for probably the vast majority of the average loans that people are taking out. So with the conventional products, you can also do probably down to 5% and in some cases even 3%, depending on your eligibility. And you have the mortgage insurance. In some cases, it may even be a reduced amount of mortgage insurance and still can go down to 3 or 5%.
And you know, one thing, I'll just maybe add 2 things just around that mortgage insurance piece, because I know a lot of times we hear with our first-time home buyers, do I have to pay mortgage insurance? Don't I have to pay mortgage insurance? But it's definitely a question because you really want to fully understand the value. For me, an informed consumer is the best consumer. So understanding all of your options can help you make that ultimate decision on your own finances. And I'll give an example from a numbers perspective. I recently purchased another property and I had options. I asked my lender for various different options as it related to mortgage insurance. I did not put down 20%. I only put down 10% on that property. And they gave me 3 different options. One option was it came with mortgage insurance and I would have had to pay that out of pocket every month. Another option was the lender actually paid the mortgage insurance, which would have bumped my interest rate up a little bit. And then the last part was I can pay my mortgage insurance up front, and then I wouldn't have to worry about it from a monthly perspective. What I chose, which was best for my financial picture, is I chose to pay my mortgage insurance out of pocket up front. Now, what did that mean? How did that impact me, right, on a monthly basis? So if I would have had that mortgage insurance included in my monthly payment would have been $180 more. With me paying it up front, it cost me about $5,000, and I paid that up front out of pocket at closing, it eliminated me having to pay that $180 for the next 10, 12 years or something. So to me, it made sense. When I remember doing the math, it was like, if I paid that $180, I would have been paying about $30,000 over the course of the time it would have took me to have that mortgage insurance removed ultimately from my payment. So for me, the best scenario was pay the $5,000, knock that $180 out of my payment, and it got me the lowest payment possible with my mortgage, which was happy and exciting for me. One thing I'll mention just around that when Larissa was just giving it examples between the FHA and the mortgage insurance for a conventional product. FHA, the mortgage insurance is there for the life of the loan. You have a 30-year loan and that mortgage insurance will be there for the next 30 years. When you have a conventional loan, since you're putting down less than 20%, that mortgage insurance will eventually go away. Once the value of your house, your loan to value, reaches, let's say, that 80%. So if you put down 5%, once you've paid that mortgage payment and you've paid equity into that property and it gets down to 80% is what you owe, then you can ask your lender to remove your mortgage insurance. Now, I like to talk in numbers because I think people can understand numbers better than just words. So if you have a conventional loan and it's $100,000, that's the amount of your loan, you put down 5%. So that means you owe $95,000. Once you're making your payments on a monthly basis, maybe after about 8 to 12 years or somewhere around that line, you're only going to owe $80,000. So now that means you owe 80% of the value of your house. That's when you can go to your lender and say, please remove my mortgage insurance, please and thank you. And then, you know, they're obligated, depending on the servicer, to actually remove that mortgage insurance from your actual payment. So you have options. You don't have those options if you were to go maybe that FHA route. But when we speak about, you know, that myth around that 20%, we like people to know that you have multiple small down payment options when you're looking to purchase a house. Larissa, talk to us maybe also about, you know, there's things out there, additional ways in which can help impact that down payment part around lender credits and seller concession. Those are two hot words that when you're in the process of purchasing a home, your realtor partners, your loan officer may talk to you about lender credit, and your realtor partner may say, did you want to get some seller concession? So Larissa, let's talk maybe a little bit about, you know, what does seller concession mean and how can that help you in your overall purchase of your property?
Yep. So a seller concession is a tool that you might be able to use, and it's going to depend on market conditions. But a seller concession is essentially the seller of the home agreeing to allow you to sort of roll in some of the cost by raising the price. Now, there are a couple conditions to that. The first thing is it has to be, the property itself has to support that price. So as you said, we'll talk in numbers. If you're talking about, let's say, a $300,000, well, let me use one of my previous examples. Let's say a $500,000 property. If that seller is looking to get $500,000 in the property and you like it, you want to purchase it, but you're going to need a little bit more to help you. What you can do is you can ask the seller, say you're borrowing, let's say 90%, which is maybe $450,000. You can ask the seller to sell the property for higher. So let's say $525. I'm calculating this as we go. But
yeah, use round numbers like 100, 200.
Right. Well, I know people would say 100,000. Or am I going to find a $100,000 property in New York? So let's just say, let's say they agree to sell you the property for $525. Well, now if they're selling the property for $525, you're borrowing 90% of $525 instead of 90% of the $500,000. So now your loan, instead of borrowing $450,000, you're borrowing $498,000. So you're getting that seller their $500, but what the main thing is that they're understanding that they're not going to net that extra $25,000. And the property has to appraise high enough to support that amount, but they're getting the $500,000 that they're looking for, and you're able to finance the 90%. So you're still able to come down with the 10% down payment. So that, and I say that depends on market conditions also, because what has to happen is in a competitive market, if you have a buyer who's asking for seller concession and a buyer who's not asking for seller concession, your seller might be more inclined to go with the buyer who's not asking for concession because they don't have to worry about whether or not the property will appraise higher, but it's still an option that's out there. So it depends on market conditions, and it depends on whether you have a seller that's willing to work with you on that. But it does happen, and some sellers are willing to do it, and it does, it's another option.
I always say, closed mouths don't get fed, so ask.
Right. And as you mentioned, the realtor, somebody you would talk to for that, the realtor will help you negotiate. The realtor will advise you. They'll also tell you whether market conditions, both the property value and sort of the competitiveness out there will support a strategy like a seller concession.
Wonderful, wonderful. And then still go with your gut. If you still think that you may want to get a couple of dollars from a seller concession perspective, then I recommend ask. Whenever I purchase a home, it could have been in the sellers. The last one I just purchased was in the seller's market, and I asked for money. They gave me some money. I could have asked for a little bit more, but I didn't want to be greedy because it is still a seller's market. But I did ask for money, and I received it. So, and I will say, my realtor advised against it because it is a seller's market. But again, I went with my gut and was happy that they were able to provide that for me. So thanks for that information from us.
Sure.
Session.
And
there's
one
different,
other.
there's different the type of loan that you're getting can really dictate the amounts of seller concession you can receive.
That's what I was about to say.
So you can receive for conventional loans, it's typically a 3% max that you can receive. For FHA loans, it's typically a 6% seller concession max that you can receive. So sometimes people may choose to go with a specific product, such as an FHA, because they can get more of a seller concession, with that 6%. But again, weigh all your numbers, look at the bottom line and see, what exactly makes the most sense. Larissa, so just aside from the seller concession, talk to us a little bit about what does lender credit mean?
Yep. So lender credit, that's one of those sort of little known sources out there that may be available to people. What a lender credit means is typically they'll have certain eligibility criteria. So it'll usually depend on what your income level is, and I say and or because in some cases it's either or, some cases both, and also where you're purchasing. But if you're eligible, your lender may also be able to give you a credit, which is money that does not have to be repaid to use towards your down payment. That could be $5,000, it could be $7,000. Different lenders have different programs and the amount varies, and they do have different eligibility criteria. Typically those criteria again will be where you're purchasing and or your income level. And it's money that can be applied towards your closing costs. So what that means is it reduces the amount of money that you have to bring to the table to pay for those costs. So again, using examples as numbers, if you're talking about, and this is important because closing costs can be pretty expensive here. So if you're talking about, say, $10,000 total in closing costs, and you're doing, let's say, again, going back to my example, let's say a $400,000 property. If your down payment is 10%, that's $40,000 that you need for your down payment, and then you're going to need another $10,000 for those closing costs. So if you're able to get, let's say, a $5,000 credit from your lender, what that means is instead of having to come to the table with $50,000, now you only have to come with $45,000 because $5,000 is coming from the lender.
Awesome. So always make sure people, when you are looking to work with the lender, if they do have lender credit options, that you're aware of those options. I will tell you that if you do select something that has potential lender credit, sometimes those credits might come with you paying a slightly higher interest rate. It's free, but it's not free. Not free. So just understand what that really looks like from a lender credit perspective. But again, it's something that's very helpful. It's something that can definitely help you get into a home, offset some of that down payment perspective. Because think about it like this. When you're looking to buy a house and you want to, I'm gonna use my $100,000 round number because that's easy for Vonetta. You want to buy that house for $100,000, and you're so excited because you have that 3% to put down. So you have your $3,000. That's not all the money that's going to come out your pocket. You're going to have to pay maybe another $7,000 to $8,000 in closing costs, depending on where you're at, and taxes and all that good jazz. So yeah, you need $3,000 for your down payment, but in essence, you probably need about $12,000 total. So now it's like, oh, hold up, $12,000, where that money coming from? So talking to you guys about the seller concession as where could that money come from? It could come from that seller concession. It could come from that lender credit. And it might increase your rate a little bit if you get lender credit, and the seller concession might increase the amount of your purchase price. So maybe you go from $100,000 to $105,000. something like that. But at the end of the day, just know, I think our ultimate goal is to make sure that you're aware of these options that are out there and see if they can fit in form into your picture. So thank you for that, Larissa. One thing I remember, just as maybe finishing up this part a little bit, is I have one of my realtor friends, and I remember she has a saying, and it's, if you can't afford the house where you want to live, buy a house where you can afford. So do we all want to live in Manhattan? Probably. Can we afford to live in Manhattan? Probably not. Give or take. Can't confirm or deny. I don't know what y'all checks look like, and I'm not counting your money. But we all may want to live in certain neighborhoods. And when you think about that, that ultimately is going to impact the amount of money from a down payment perspective. So what could be, when you're thinking about that market that you want to live in, Larissa, maybe talk to them about looking for maybe a cheaper home in a different location.
Yep.
What other options do people have as opposed to maybe just having to put down a huge amount, that $500,000 that you were talking about, because they wanted to live in that specific area that maybe that's not where their pocket is ready at for today.
That's right. That's right. And I think, of course, for a lot of people, I'd say for just about anyone, especially being a first-time buyer, the process can be an emotional process. It's exciting, but on the other hand, it's very easy to get attached to the idea of where we want to live and the things that we may want in a home. But what often happens is the reality of the market may be something completely different. So what that means is it's important to start with, and not just from a down payment perspective, but both down payment and a monthly payment, it's really important to start with your budget and work backwards and back into what you can purchase. As Vonetta said, I think there are certain places we probably would all love to live, but when we see the reality of what that costs in dollars and cents, how much it's going to cost, number one, the price of the home, which translates to how much money you need to have up front out of pocket and how much you have to pay monthly in terms of mortgage payment, and not only mortgage payment, there's taxes, homeowners insurance, and if you're looking at condos and co-ops, there's homeowners association dues. So when you factor all those things in, the reality may be that that's not where you can comfortably afford to buy, and that's okay. So I think from that point, you have to really look at where does it make sense for you? And that might mean moving a little bit further out. That might mean looking at a different property type. Right, and that's exactly right. And there are some very, very affordable areas that really distance-wise aren't even that far. Let's say if you're in Manhattan and you're commuting in, that are much more feasible and much more affordable. And it may also mean looking at a different property type. So for some people, you may think that you want to be in a single family, but when you look at the numbers, it may not make sense. But guess what? In that same market, a two-family, it might cost a little bit more upfront, but it may also help you generate additional rental income monthly. That may be a more affordable option. So I think that's very important. And actually, I'll tell everybody a little secret. As lenders, when we qualify you for a mortgage, that's exactly what we do. We really take the monthly amount. So we look at your income, we look at what you have coming in and what you can afford to pay. There's a very specific calculation. We figure out what the maximum is that you can afford, and then we work backwards and back into a loan amount. So when I was a loan officer, I would often sit with first-time buyers, and I would talk to them about, they would talk about where they want to live and what type of property they want to be in. And a lot of them, because they had kind of already looked and kind of had an idea of what houses cost, they told me, what price they wanted to buy at. So like, oh, I know I want, again, I'm just going to use this number again. I want this house for $500,000. But when we talked about what that meant in terms of a monthly payment, a lot of times people realized that that wasn't what they were comfortable paying. And another piece to that is again, not necessarily related to down payment, but something that's also important to consider are real estate taxes. So depending on where you're buying, the real estate taxes can make a really big difference in affordability. So if you're looking at high real estate taxes, again, that real estate tax amount, we just take it, divide it by 12, and that's what's added to your monthly mortgage payment. So if you're looking at something with $12,000 in real estate taxes compared to a home, let's say, with $6,000 in real estate taxes, that's a difference of $500 a month. So for some people, that makes the difference in I can afford this versus I can't afford that. So it's very important to look at those factors. So the home price, and then what that means in terms of a down payment, and what that means in terms of a monthly payment, and then start there, what's comfortable for you, and work backwards into what you can afford to pay and what you should be looking at.
Awesome, awesome. So let's maybe just take a pause for a second to see if there's any questions out there.
So we have a question here. So this has a lot to do with like buying a fixer-upper that requires a reasonable amount. So how would you look at if you have a property and it requires a certain amount of money of work and it's an expensive location? How would you factor that in, and especially if you're looking to fix up the property, if I understand the question correctly?
So, so first of all, HGTV, aside from CNN, is my favorite TV channel. So yeah, I think HGTV got us all thinking that we are flippers, buyers and flippers of properties. Yes, I love it. I love it. So to answer the question, it just all depends on what kind of financing you're getting. So if you're purchasing a property that's going to need to have some major work done where you and so then you're doing it as an investment, or you could be doing it as a primary residence, you're going to need some type of renovation financing in order to purchase that property, get the financing that you need to renovate the property, and then have the property look super fabulous afterwards. One thing I would make sure that I caution people to understand is that a lot of times you might hear the words 203K. So you say, oh, I want to buy a house and I want to, repair it. And update it and then, live in it as my primary residence. And people may just throw out there 203K. Let me let you understand something, people. 203K means FHA financing. So make sure that when you're speaking with a lender and you're looking to be able to purchase a property that you want to repair and live in, that people are speaking in terms of renovation financing, because that's what it really is. Renovation financing gives you options of whether you're going to get conventional funds or you're going to get FHA funds. So make sure you understand that there are two options to purchasing and renovating a property from a loan perspective. There's a conventional option and an FHA option. And just so everyone on the phone understands this one thing, so FHA loans are fabulous. They are there for people for various different circumstances, and they create home ownership for millions of Americans in this country. But what I really want everyone to walk away with from this call is that if you are getting an FHA loan, it is because you have to get an FHA loan. Okay, and I pause on that because I really want you to understand no one should just be getting an FHA loan. They should get an FHA because they can't qualify for a conventional. Okay, so always understand that if an FHA is the option that is for you, make sure it's because you could not get the conventional and you're clear with why you're getting an FHA. And I say that, and I mean it wholeheartedly, because it's something that's really important. Sometimes I just want to make sure people understand there are reasons to get FHA, and it's an amazing product, and it creates home ownership, and it does some things that conventional products can't do. But again, please always understand if you're getting an FHA, you know exactly why you're getting an FHA loan. But I hope that answers the question from if you want to purchase something, then you're going to require, you can utilize, not require, but you can utilize renovation financing in order to purchase that property.
Yep, and Vonetta, I'd like to I just want to add a couple things to expand on that, specifically on the renovation topic. So there are a couple ways to go. One of them is, just as you said, taking out you'll hear it called renovation or rehab loan. So basically, you're financing the amount that's going to be needed to make the repairs to the property. And as Vonetta said, that's there used to be other options out there, but right now the FHA, what they call 203K, the rehab loan is the main option. The other thing though is if you did, for example, have some money out of pocket that you wanted to use. So let's say that you had some money and you wanted to purchase a fixer-upper, that's another possibility. But the part of that you have to be very careful about is that, especially for both conventional and for FHA, there are going to be specific property standard requirements. So what that means is if the property's in, property it has to be in a certain condition, basically it has to be livable in order to get any financing from a bank. So if you had some money out of your own pocket and you were going to borrow some for a mortgage and then use some to fix up a property, that is an option, but you have to make sure that the property meets the lender's standards just to get the loan, to get the mortgage to begin with.
Right. Awesome. Anything else, Norvell?
This is just one question I received a text here. So in regards to FHA, if you're looking to purchase a home and the owner does not want you to have or doesn't want to sell you the property because of an FHA loan, is that an issue? Is that something that you've come across?
It's discrimination.
So that, yes, that's, well, here's where that can come up. Can come up. FHA is a little bit stricter about property standards than conventional financing is. And we're talking, by the way, here about FHA and conventional, because those are two of the most common programs you're going to hear, but there are others. But FHA and conventional, FHA is a little stricter about property standards. So to give an example, with an FHA loan, you can't have exposed electrical wiring, let's say. I had situations on FHA loans where there was a porch and it was like stone, and there were a couple of stones that were out of place, and that had to be repaired because FHA says that you can't have things like that. So that had to be repaired before the buyer could close. So there are things that FHA won't allow that conventional might allow. They might even have specific requirements about the type of electrical socket. So it'll typically be sort of safety type of things. You can't have, like, if the property has a basement, there has to be a handrail going down the stairs into the basement. So if there's no handrail, then it has to be added before you can close. So if you hear a seller saying that they're not going to accept FHA financing, it's because there's something about the property they know that won't meet FHA requirements. So I would say the most important thing is to talk to them about what it is, and if it's something that might, change whether or not you want to purchase that property. And if it is something, if you're still willing to go forward, it may very well be something that FHA won't allow, if they're saying that they don't want FHA financing. Or FHA, the other thing that might happen is they might stipulate that it be repaired before you can close. And what's going to happen is a lot of sellers aren't going to want to spend the extra money to fix things like that before they go to closing, especially if they don't know for sure if their buyer is going to close.
Awesome. Thank you. And then, so I will just maybe move a little bit just around sources of down payment. So there is a lot of free money out there, people, from down payment assistance programs. Let me see this. Freddie Mac actually did gifts from people. So Larissa, let's maybe just talk to them over this next couple minutes, just around some of the different sources that are available from a down payment perspective that can help consumers.
Yep. So one of the most common sources we see, again, going back to what we said before, nowadays it's, just regular living expenses are very high. So it's not as easy for people to save that much money anymore. So we're being, I think, a little more creative about where we look for down payment money. So one of the most common sources, particularly with first-time buyers, or a very common source, is gift money. You can use money that a relative gives you or gifts you towards your purchase. The most important thing is you just have to be able to document that, number one, that money came from a relative, and two, you might have to provide a paper trail. So for example, if they're giving you a check, you may need to provide a copy of the check. And then there's also a document called a gift letter, which all lenders are going to require to document the gift. And then they may need to see that that money goes into your account, but that money can be used as a source of down payment. So it could be, parents, it could be grandparents, siblings. It should be a relative, but they'll just have to sign that letter. And you sign the letter as the buyer or the receiver of the gift and document that they've given you that money, whether it be an electronic transfer or a check, but that's one source that can be used for your down payment.
Awesome, awesome. And then what about any down payment assistance programs? What is that, so our viewers can be aware?
Yeah, so there are a lot of funds out there for down payment and closing cost assistance. And they can be, eventually, if you stay in the property, they can be free, meaning that you don't have to repay them. So there are a lot of programs out there through local municipalities, that could be states, counties, cities, that offer money towards down payment and closing costs. The amounts vary. And actually, just about every municipality has one form or another of some type of down payment assistance. So, for example, in New York City, there's Home First through New York City Department of Housing Preservation and Development. In New Jersey, for example, in Essex County, there's the Neighborhood Lift program through Wells Fargo and New Jersey Community Capital. It's up to $20,000. Depending on your income level and where you're buying. Actually, excuse me, it's only for Essex County. In Connecticut, there are different programs. So each area has specific programs. Typically, the money comes from the municipality. Again, it could be the state, it could be the county, it could be the city. And a lot of times there will be a nonprofit who manages the program. It will have income and purchase price requirements. So usually you'll have to make less than a certain amount, and that amount is going to vary based on where you are. So it's based on the median income, usually for the area, and it's a percentage. So they'll ask you for things like tax returns. There's an application process. They'll ask you for things like tax returns to make sure that you're eligible. One thing that we should say, I think with the programs we talked about earlier in these programs, these are all for first-time buyers, and they're all for owner-occupants. So number one, first-time buyer usually means that you haven't owned a home in the 3 years before. So you could have even owned a home in the past, but in the 3 years before you're buying, you could not have owned a home. And then you also have to be living in the property. So if you're thinking about property to invest in, that's a whole different category with a whole separate set of requirements. So most of what we're talking about here has to do with
next series.
Right, exactly. Those are the fix and flips that we talked about. So the payment assistance programs can be a great source. Usually they'll just require that you stay in the property for a certain amount of time. And then as long as you stay for that amount of time, a lot of times it'll be forgiven. So it'll be forgiven gradually or over a certain amount of time. And again, we could be talking about $10,000, $20,000, some places are even up to $40,000 and $50,000 that goes towards your down payment. And so that takes a big chunk of that money that you would usually have to come up with. And it could be used towards down payment and towards closing costs in most cases.
So I just to add to that, I would encourage everyone on this call to just, wherever they're looking to potentially buy, just Google down payment assistance program in, Manhattan, down payment assistance program, Brooklyn, wherever you're at. You're narrowed down to your city, your town, and just Google down payment assistance program and see if something comes up. Because in addition to whether it's the counties that's offering, nonprofits, a lot of local nonprofits also offer their own programs because they've received funding from various different entities to be able to offer down payment assistance programs. And I will definitely let you all know that the state of New York and the state of New Jersey both offer programs of down payment assistance. And in addition, as just maybe a closing part on that, is people are able to get multiple programs. So let's say you're getting the state of New York program and it's $20,000. You can also maybe get a local program of another $20,000. Now you have $40,000 to put down on that big house that Larissa's buying for the $500,000. Now you have $40,000. So you can layer a lot of times, and we see this in New York very often. So I don't think this is something out of the normal. We see in the New York market that people that are getting down payments assistance programs are typically layering the program. So they're normally getting 2, sometimes 3 programs in order to help them buy that house. And I'm talking about big dollar amounts. So not just, $5,000, I'm talking about big dollar amounts, $10,000, $20,000, $30,000 worth of assistance. Jersey City has a program, and I think theirs is either $30,000 or $40,000. So
$40,000, right?
out there that just offer assistance, and it's a potential that you'll be able to utilize multiple programs in order to get to purchase a house. So
that's right. And you can also combine those with those lender credits that we talked about earlier.
Yes.
So if you're working with a lender that has a credit, you can use down payment assistance. You may be able to combine more than one down payment assistance program. And if that lender is offering a credit, you can also use that to help with closing costs. And it all adds up. It does.
Yeah, so, lender credit, seller concession, down payment assistance, anything we can do to help educate you all, to get you into home ownership and build wealth, let's make it happen. So I want to just maybe switch over a little bit. I know we're running short on time, in about 10 more minutes, and just maybe talk a little bit about credit. So we did the myth before around what was the amount you had to have for down payment. So let's do another one and say, what is the minimum credit score you think you need to buy a house? Let's everybody just like add a chat, or even like just 3 of y'all. Hurry up, please. We run out of time. Oh, okay. I see some coming through. Norvell, what do we have? Minimum credit score to buy a house.
We have a 580, 720, varies. Someone keep putting varies.
They're precious.
They cover all bases.
They're right, though. They're right.
I know. Yeah, it is. You're absolutely right. So I'm going to guess here. I'm going to say 780. Hopefully I don't go over, like the price is right.
What you said? What was your number?
680?
I'm about to get this, brother. I'm not upset. Okay. Thank you all for the participation. Drum roll. It varies, no. It does. But the myth out there, Larissa, what's the myth?
The myth is that I think a lot of people believe that you need a 700 or like a 720. In other words, excellent credit to purchase a home, and you do not. So we do say varies, and as I guess the theme will continue as we talked about earlier, it's going to depend on the specific loan program. But in a lot of cases for conventional financing, you really only need a 620 or maybe 640 credit score to purchase a home.
Definitely.
So you certainly don't need to have that excellent. It's more like 620, 640. And actually, in some cases on FHA, you may even be able to have a score of 580 to purchase.
Yes.
So you do not need to have at all excellent credit to buy.
Yes, and even think about it like that. Just because someone may have such a very low score of a 580 doesn't mean that their current picture is a tragic. Maybe they were working on their picture and they're still getting their life together. From a credit perspective. Because remember, people, credit can change every month. Boop, you get a new score, you make some updates, and you can fix it. But
yes, it is. And most of the time what lenders are going to look at, what they're most concerned about, is how your credit looked over the year to 2 years before you made this purchase. So if you had past issues, and especially if you can explain them, for example, some type of hardship, some major situation, and if they can look at that credit report and look at the documentation, they may ask you for other documents, but if they can kind of piece together a story from what you present in documents and what's on your credit report, even if the score is lower, that they will give you some sort of latitude, and you may be able to get approved where you wouldn't otherwise have been approved.
Awesome. And then I will also just add one little caveat that people might not be aware of. If you do not have credit at all, so you have no credit score, lenders have a way to help you build credit. So, and the way that they do that is they ask you for certain things. So they may say, give me 12 months of your cell phone bill, 12 months of your cable bill, 12 months of your light and gas bill. And they take 4 things like that, your insurance payment, your car insurance, and they can take those items and then they can build credit for you. This is through the lender, so not going through like a credit agency or somebody that says I can repair your credit, not anything like that. You can go right to your lender, and if you have absolutely no credit, some lenders have the capacity to be able to collect certain documents from you and then build credit for you in order to get that financing. So there are options out there that are available for people that might just, work cash all their life and then focus on having any debt or from a credit perspective.
And one other thing about that, it's important to also note that that's non-traditional credit, which is an excellent option for some people, but it doesn't take the place or doesn't substitute if you had bad credit. It's really for people who don't use enough credit and didn't have the opportunity to build up what they call a traditional credit profile through the credit bureaus, but still are able to make monthly payments and make regular payments. So it's like a way of building another credit history, but it doesn't substitute for bad credit. It doesn't make up for bad credit, but it is an alternative, or sometimes it's called alternative credit. It is an alternative for people who don't have sufficient credit.
Awesome, awesome. And then we wanted to just maybe close it with just a couple of things that sometimes people think, because a lot of times people, and I will tell you, when we work in this first-time home buyer, people disqualify themselves. They think, oh, I have a collection, or I did bankruptcy, or I have judgments, whatever the case may be, and they disqualify themselves without even ever speaking to a professional from the dream of homeownership. So there's a couple of standout things that I think people sometimes may not even know that these things might impact them from getting home ownership. So 2 call outs I wanted to just talk about to make sure that if this is part of your situation, that you make sure you clear these things up, because they could impact home ownership. So Larissa, there 2 of my things I have written down was just around motor vehicle surcharges and child support. So maybe just talk a little briefly just about how could those things impact home ownership.
So Vonetta, thank you. When you say motor vehicle surcharges, what did you mean by that?
From a judgment perspective. So you've had that.
Ah, okay.
Yeah. Mm-hmm.
Gotcha. Just wanted to make sure. Yep. So that exactly. So when you're talking about motor vehicle surcharges, or maybe from a repossessed motor vehicle, and child support, and actually a lot of other debts can end up this way. When you have a judgment, that's sort of a hard stop, right? And there are a couple of reasons for that. It's not just, so a judgment, let me go back, means that you owed a debt, but that creditor went to court and sued for the legal right to recoup that money from you. So number one, there may be other problems once you have a judgment. That means they can levy your bank account, or they may even be able to garnish your wages to get back whatever money it is that you owe them. So that's a bigger issue with judgments. But in terms of home ownership, judgments have to be paid off before you purchase. Number one, they'll impact your credit. So your credit score will take a dip once a judgment is filed against you. And it's way better to try to work with that creditor and negotiate some kind of payment arrangement than to get to the point where they've gone to court and they've gotten a judgment. Once there is a judgment, it affects your score, so your score will drop. And besides that, it's going to have to be paid off, not only because of the credit impact, but because there's a legal impact. So potentially, once you buy a property, that judgment can actually become a lien against your home, and no lender will allow that. So they'll always want those judgments paid before you can close on a mortgage. Child support can be the same. So child support is the same thing. Unfortunately, back child support eventually, because it's a legal matter, there can be a judgment placed against you. And once you have a judgment, that can impact you a couple ways. Not only the judgment as the debt can impact your credit and would have to be paid, but in terms of qualifying monthly, in terms of what you can afford, the lender is going to take that and they're going to count that like a debt against you. So if they're looking at the monthly payment, they're going to take that out of what you might be able to put towards a mortgage, and it means you would probably qualify for less.
Awesome, awesome. So motor vehicle surcharges, judgments, collections. What I would encourage everyone to do is, number one, never disqualify yourself. Unless you speak to a professional and they tell you no, then go see like 5 more and make sure you get like 10 no's before you settle down and fix your picture. Because remember, everybody, lenders have different criteria, and you might not qualify with one, but you may qualify with another. So let's just make sure that you're not disqualifying yourself, that you, even no matter what your picture is from a credit perspective, it can be fabulous, it can be so-so. No matter what your credit picture is, always make sure that you're speaking with that professional and helping them to understand and guide you throughout that process. So we are, I want to thank everyone for for if you playing around with us with the chat and asking questions, being engaging. We really definitely appreciate it. Larissa, you also as well with all the great your great knowledge and feedback and answers. This is a series that the organization has put together, so we're excited to, preview some additional things that are going to be coming. Just bringing you guys some different people to talk around some top realtors, top loan officers, just to give some more insight. Also, just around the mortgage process period. We literally only talked about two topics. It's over. There is massive. There is a lot of information out there. And again, that educated consumer is the best consumer. So we want to make sure that everyone is educated. We want to make sure that you're all building wealth and that we're helping you get those tools in order to build wealth. I love the questions around investing. I want to do like an investment series because there are a lot of people that are pulling groups together to do purchase investment properties. So all good stuff to come. Larissa, Norvell, I'll turn it back over to you or Andrew, whomever.
Hey, everyone. Once again, thank you so much, Vonetta and Larissa, for your time and knowledge of sharing the world of real estate. Like you said before, we're only dipping our toe in the water right now. We want to be fully immersed in this dynamic industry. This industry has made people millionaires, but more importantly is your home. And your home should be somewhere you can rest your head and feel valuable and leave a legacy for your family going forward. So we'd like to thank our two panelists, our two experts, and our two friends for donating their time and knowledge for us. And again, this is a series, so we'll be doing more episodes of this. We'll send out a questionnaire for your comments and feedback because it's really interactive. You make the series, you in the community, our network, our members, and our corporate partners. So we want to make sure that we'll get the full value of the relationship that is definitely a two-way street. And with that being said, I'd like to thank everyone for attending this session. Norvell, do you have any additional comments?
Please check out our website, NYBLACKMBA.org, for additional details. We'll send out a survey, and this is part of our digital series provided by the Metro New York chapter of National Black MBA. Have a wonderful day, everyone.
Yep. Thank you.
Thank you.